Maverick Traders. Welcome out to your trading room for the week coming up of September 4th through September 8th. Markets will be closed on Monday, September 4th for holiday. So let's jump into it and talk about markets. Here's what we're going to be discussing today. We're going to go through the news of the week, what happened in the markets this past week and where that puts us on a path towards. We're going to talk about current market conditions. There have been some changes on that front. Also sector rotation. And then we'll, as always, finish with some new trade ideas.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, so let's talk about last week. Market staged a recovery, and the S&P had kind of a head and shoulder top, the NASDAQ the same thing, and we recovered above those moving averages. I talked about this last Monday in the market roundup, that we were kind of at this make or break level where we could confirm the head and shoulders with a break of the neckline, or if we get back above those moving averages, it's shorter term bullish, and we've done the latter. We've strengthened, we've pushed back above those. It doesn't set in motion a strong bull market. It actually mixes up the charts. It has now downward sloping moving averages with upward price action. It's really kind of a mixed bag and a little bit more of a zero. You're going to see zero scoring a lot out there in the sector. So economic numbers stable. We got strong employment data on Friday. Slight miss on GDP. GDP was expected to come in a little bit better at 2.4, and it only came in at 2.1%. Core PCE, which is a Fed inflation number that they pay close attention to, came in line at 0.2% for the month. The two-year yield declined, and really markets are starting to price in a bet that we're not going to hike rates like was being priced in previously. So all of a sudden we're seeing a transition where the markets are expecting the Fed is on hold. The Fed is not going to do as many hikes as was maybe feared just a couple of months ago. So as we look at the week, again, a couple of highlights here. We had GDP missing in the U.S., 2.1 versus the 2.4. We had PCE coming in line, and then the jobs numbers were strong. We had 187,000 jobs. It was only expected to grow by 169,000, so a nice beat there of stronger employment data. Last week's trades, we highlighted a few. SRE was a bearish idea, and even with the markets going higher, this stock pretty much fell all week. So that was a good outlook there. We also had Host Hotels, another one where we had a little bit more bearish outlook. And this one was basically flat. It jumped up a little on Monday and then finished weakly towards the end of the week. I would call that a zero move. ABCM, this one we highlighted as a bullish idea. It basically went sideways as well. No real movement there. EMR we highlighted as a bullish trade, and it went slightly higher, not massively, but definitely up. And then last but not least, Discover Financial we highlighted as a bearish idea, and it actually rallied a little bit. So it's backing and filling some of this deterioration that happened previously. So a little bit of a bounce back there. As we look at markets, starting with the S&P and the NASDAQ, as it's been the case, as goes tech, so goes the market. Well, this week we saw a nice recovery in tech. As we look at the returns, the NASDAQ Tech 100, NASDAQ 100, and IWM, which is Russell Small Caps, outperformed at plus 3.7. Oil sharply higher at 6%, and energy equities have been a favorite place of mine. Of late, we've been highlighting them in the market roundups and such, and they were on a tear this week. So good price action all the way across the board, everything up over 1%. Gold had a nice week, even with equities rallying and some of the slowdown in volatility. Gold was 1.4% higher. So as we look at the charts, here's what we had highlighted as a possibility. You had stalled out here, you made a higher high, and then you proceeded to stall out here. You can see we came up underneath the moving averages, we got resisted. We fell back sharply for 2 days. And then we started to rebound back up, and it becomes make or break. Either you were going to come and break the neckline, which would confirm this as a head and shoulders top, right? Here's the head, here's the shoulder, and then this would be the neckline. That would be the bearish move. As we said, if you go back above these moving averages, it negates the price pattern and it actually sets the market much more in a more bullish fashion. And it was just technical. As soon as we broke back above those moving averages, you can see the buyers come in aggressively. You could see volatility and other things falling violently lower. NASDAQ, same chart. Same type of dynamic, same idea. Do we stay or do we go? This one resisted at first and then broke out to the upside. So it sets the markets more in a stronger pattern. But here's what I don't like. Again, it's mixed. It's not like, oh, everything looks perfect. Why do I say that? Well, although you're above the moving averages are mixed up. The 20's below the 50. Well, that's bearish. They're not sloping upward. They're sloping sideways. Well, that's neutral. Price action's above them. So you've got something that's bearish, you have something that is neutral, and you have something that is bullish. To me, that is not a clear signal. That speaks to, well, it's a zero outlook. It's basically, we're going to tug a war here. We're going to fight it out for a little while. This could get more bullish, and you could have a recovery and crossover in these moving averages here in the not too distant future. It's going to take the market holding above these moving averages to kind of allow that to happen in the coming weeks. But ultimately, I think there's something bullish, neutral, bearish. It's just not a real crisp, clear picture. As we said, as soon as the markets recovered above those moving averages, look at the VIX. The volatility index imploded this past week. This speaks to fear coming massively out of the markets. This is the markets pricing in the possibility of a big deterioration and then flipping that and saying, nope, it's not going to happen. So as the markets became choppy and bearish, the volatility went up. Now that we're recovering, the markets are saying, oh, we're in good shape. No problems there. The volatility has imploded all the way back down here to those lows. So just as quick as it came, it went, and it is gone, and we're all the way back. So the VIX is suggesting that we do not have a big deterioration, that there should not be as much fear in the market as what was previously worried about. And this again gets to the Fed expected to be on hold and not expected to raise rates much more in the future. This is pricing that in, that basically we're at the end of the rate hiking cycle according to markets and according to their outlook. Now, this coming week, markets, mixed bag. We're going into a seasonally very weak period. September is the worst month historically for stocks. In fact, it's the only month that has a negative return historically. So it is not a great period of time. The 10-year still is important. If bond yields keep going higher and higher and higher, that would be pricing in more rate hikes and more higher interest rates and tighter monetary policies and all of these sorts of things. The markets are going to have trouble, but we saw a nice reprieve of those things this past week. On the economic side, as we look at a few highlights, again, markets closed on Monday for the holiday here in the U.S., so New York Stock Exchange closed. We've got RBA statements. If you're an FX trader, our FX division is certainly keen on that. Bank of Canada, so a lot of central bank meetings. Here in the U.S., there's just not a lot. I mean, you've got a Fed speaker. You always have initial jobless claims every single week. You've got some ISM services PMI, but there's really not much. It's a very quiet week here in the US for economic numbers. So, our outlook. Last week, we were in danger of breaking down. This week, we've seen a nice recovery back above the 20, back above the 50, but their slope is off, their cross is off, which is 20 below 50 is bearish. We're at a zero outlook right here in the short term. Let's look at a few sectors, and you're going to see that the trend is very much in that same vein as we look at these sectors. Now, it was a great week. Technology, the outperformer, up 4.4%. Energy and materials not far behind. The laggards and the big disappointing areas, real estate, healthcare, and utilities. Those would be the three that really underperformed. Now, as we look at this a little bit closer, you can see that really the average was around 2%. So around 2% was the average. Anything 3 or above, very strong. Obviously, utilities in a league of their own. So if we start you with the utilities, this is a very bearish sector. Out of all of the sectors, really the worst performer and made new lows this week. You can see that piercing of those prior support levels and this low base pattern. Utilities, a -3. A little bit more positive price action in XLC. At least you have the 20 above the 50. You don't have that in most sectors. You have that in communication. So I'm going to give it just a little bit better score than most at a +1 because it has just a little tiny bit better bullish characteristics. And then also real estate, a little bit more bearish. You've got not only the downward sloping moving averages, the crossover, you're still below the 50 MA. So for me, real estate also a little bit more bearish at -1. Everything else until we get to energy will be a zero. You're going to see industrials, mixed picture. 20 below the 50 is bearish, but you're back above that. It's like the markets. I'm just not quite sure. Zero on industrials. Healthcare, this one was a disappointing group for the week. Really underperformed and was only flat on the week. 20's above the 50, but you're back here at the lows and really didn't make any gains. So I'm not going to upgrade that. I'm just going to keep that at a zero. You've got financials, a little improvement, but again, some problems here. 20 crossing below the 50 and downward sloping. It's a mixed picture. Financials are a zero. Consumer, again, 20 below the 50 and some downward slope, but you're back above them. I don't know what to make of that. I think we're in a choppy market environment. Zero on consumer. Technology, 20 is starting to curl up just slightly, but again, it's still below the 50. These are bearish things. You're back above them in price. I could have gone maybe a tiny bit upgrade, but I think that's a zero. Again, it doesn't have the 20 above the 50 like we saw in communication. The reason I gave communications that extra is because it deserved it. It had that little bit extra. Materials, while you're above the moving averages, again, they're mixed picture. They're in bearish crossovers and such, so still zero there. Last but not least is a sector that you could have been on board with even while the market was weak the past couple of months. Energy has been strong. Look at the 20 crossed above the 50 back here, started to upward slope. You want to be a buyer of energy back here and here on the dips and here on the dips and there on the dips and everywhere a dip. You want to be a buyer. So energy breaking out, the only sector at new highs, new multi-month highs and such. Great price action. 20 remained above the 50 and upward sloping. If there's a sector that's out there that's been strong and powerful, it has been energy. So as we look at them, again, I gave communication services a little upgrade, real estate a little downgrade there, utilities remain the obvious weak sector, and in energy, the obvious bullish sector. Everything else, I think you've got mixed picture galore. So, healthcare, industrials, financial, consumer, materials, and tech, all at 0 ratings. Now, let's get to some trade ideas. So, in real estate, which was a little bit more negative, Simon Property Group is in a bear rally pattern. You can see we've come up underneath the 20, which is downward sloping. Remember, a lot of stocks have moved above, or sectors have moved above those moving averages. Look at Simon Properties, still below them, still downward sloping, new bearish crossover. So even in the midst of a market recovery, this looks more like a bear rally short pattern setup. So we highlighted an October 115, 120 bear call spread. In that trade, you're really neutral to bearish. It's just not a real bearish trade because all you'd need is for it to stay right here at 115 or lower. This bear call spread would expire for a max profit of the credit received. So Simon Property, bear rally short setup. Communication services, we said we were a little bit more optimistic on. Well, Match Group happens to be in that sector. Here I think you have a triangular pattern, a symmetrical triangle that was broken out to the upside on increased volume. I like Match Group, even with Friday's kind of give back of the highs, maybe an October, September diagonal spread. Buy the October 45, sell the September 48s and a half, something along those lines. And you're basically targeting the stock to be a little bit higher here for the next couple of weeks. And then if the September expires, you can hold that long call. You can do a lot of different things with it. Interesting setup, and I think we've broken out. And again, bullish characteristics. The 20 remained above the 50. We just started to break out. You're just starting to see these moving averages turn and begin to slope upward. So nice price action there in Match Group. Industrials. Industrials have UPS, and UPS has been a drag. Look at the downward price action, recent new lows, even in a better market environment. And I'd call this an inverse cup and handle pattern. You establish a major support on big volume there. It becomes exhausted. You rally. You're unable to hold the rally. You plunge all the way back to the support. You give a weak rally, and then the break happens. So looks like the floodgates might open up. You could play this shorter term. You could go a 2-week bear call spread, targeting the stock to be below 165, which isn't too much lower than current levels, but certainly UPS looks like it should continue to underperform, and I think a new low is coming in the not too distant future. Energy, I've loved energy for some time. We even talked about it Monday in the market roundup. I've talked about it for weeks. I think it's the best sector out there, quite clearly. So is it long in the tooth? Could it be running out of gas? Maybe, but a lot of these things are just starting to break out. Here's Baker Hughes. It just broke above the moving averages. You could play this as a little October, September diagonal call spread. Buy the October 37, sell the September 38s. Hopefully we finish just below 38. That expires, and then it keeps climbing as you own the October. There's a few different choices and decisions that you'd have to make along the way managing that trade. But Baker Hughes just broke out to the upside out of what has been a multi-month base. That should have follow-on buying. Now, as we look at our market outlook, it's turned a little bit mixed. You've got mixed signals, so it's not a time to be too aggressive. Volatility has also plummeted back towards the lows, so there's not a huge cost in buying options that might be a little bit more attractive at current prices and given the implosion of volatility, but be careful. Neutral price action, choppy price action is probably going to be there in most sectors. For this week, again, because of Labor Day, markets are closed on Monday. We'll have market roundups every other day of the week. And let me also remind you, Maverick traders, to get signed up before Sunday night for fantasy football. If you want to play in our Maverick leagues, this is our 10th year in a row doing it. We've sent out a couple of emails. Make sure you check your email inbox. And if you want to get signed up, click on one of those links. Hopefully, they're not all signed up. They're not all full by the time you get this message if you want to play. Thanks everyone for being here. Have a great week, and we will see you next time. Goodbye, everyone.